Hi class. In this video we're going to talk about Chapter 1. If I can get it to start, there we go. So Chapter 1, it doesn't have a lot of calculations in it. It's more a discussion about the theoretical structure of financial accounting. And we're going to talk about some things that should sound familiar to you because they're going to refer back to previous classes you had. But let's try to get through this. As you know, the primary focus of financial accounting is to provide information to external users. Now, when you took Accounting 121 that we learned in managerial accounting, the primary focus is to provide information to internal users, such as management, so that they can make managerial decisions. But financial accounting is going to help investors, creditors, and other external users better assess the risk of investing in the company or providing loans to the company, and to try to ascertain whether they're likely or not to get a return on their investment or loans. So when we talk about financial accounting, the main thing that we're thinking about, or the end product that we're thinking about, are the financial statements. And there are 4 financial statements that make up a full set of financial statements, and those are the balance sheet, the income statement, the statement of cash flows, and the statement of shareholders or stockholders' equity. So that's the same thing. And also the financial disclosure notes accompany those statements, and we'll talk a little bit more about disclosure later on. So when we talk about capital markets, we're talking about the markets that help to allocate resources to different entities. So when we talk about the stock markets, for example, that is the place where stock are sold and the company raises capital to invest in their company. Initial market transactions are the transactions that occur the first time a company issues stock or issues bonds. So that's just their initial issuance of either of those transactions. A secondary market transaction occurs when stocks or bonds are traded between individuals or some other institution. So the corporation doesn't get any new cash from those transactions. So for example, if Walmart issues 1 million shares of stock, the first time they do that, the people that buy those stock are paying money to Walmart for the purchase of those stock. Walmart's selling those stock, people are buying those stocks, so the money goes to Walmart. After that, that stock is out on the market, and people can buy and sell Walmart stock amongst themselves. And when they do that, the money doesn't go to Walmart, it goes to the people who are buying and selling those stock. So that's important to remember, because after the company initially sells that stock, then they don't get money from that stock any longer. And of course, why do investors and creditors provide capital? Well, hopefully because they think they're going to get more money back than what they invested. Some things that they think about are the rate of return on their investment. Of course, they want a high rate of return on what they invest or what they loan. Another thing they have to think about is the risk that they won't get that rate of return, or that they may even perhaps lose their investment or lose the money that they loan to a company. And this is just a calculation on the rate of return. So basically you're looking at the money that a company, or that an investor gets back from their investment. So in this case, we've got an investor that's receiving $400 in dividends, and the $600 share price appreciation is just the increase in the value of the shares that they own. So their shares have gone up in price, so they're worth more, so they have that potential in return on their investment as well. So we got dividends, the appreciation of the share price, and we're going to divide that by how much they initially invested, and it looks like they're getting a 10% rate of return on their investment. All right, and just an example of uncertainty. Which would you pick? Well, you know, there's not really a right or wrong answer. We've got investing $10,000 in a savings account insured by the U.S. government that will generate a 5% rate of return, or taking that $10,000 and investing it in a profit-oriented company, such as buying stock in a company. Obviously, one of those choices has more risk. When you're investing $10,000 in a profit-oriented company, you may lose all of the $10,000. You don't know. Investing in the U.S. government, there's less risk there, and they're telling you that they're going to pay you 5%. So most likely you're going to get that 5% rate of return back on that investment, which isn't a great rate of return. You may get 10 or 15 or 20 a return on the investment in the company, but there's also more risk that you won't get anything back. All right, primary objective of financial accounting is to provide information that's useful so someone can make a decision, and that information should help investors or creditors or whoever's using that financial information evaluate amounts, timing, and uncertainty of their investment or their lending. So thinking about cash versus accrual accounting, and this harkens back to a conversation that you probably had in Principles of Financial Accounting 1. So cash basis of accounting measures and reports information based on when cash is received or when cash is paid. So if cash isn't paid at a particular time or it's not received at a particular time, then it's not recognized. Accrual basis of accounting recognizes revenues and expenses regardless of whether cash is received or when cash is paid. So we're looking at when we earn the revenues, when we owe the expenses, and not necessarily when we actually pay them. So here's a cash basis example. This says Carter paid $60,000 for 3 years rent at the beginning of year 1. So this is cash basis. We've got sales, cash receipts from customers, cash disbursements from ourselves. So there's that $60,000 rent that we paid in cash. Salaries we're paying to employees, and then utilities. So under the cash basis of accounting, we're recognizing only cash that's coming and going. So we've got sales on credit up here, which really has no relevance, no reporting in cash basis of accounting. Down here we have cash received from customers, so that's what we're going to think of as what we've earned. So in the year 1 we've got $50,000 cash receipt, and then we've got some cash payments. The prepayment of 3 years rent, that's when the cash went out. So that's when we recognize that expense. In year 2 and year 3, there are no cash expenses for rent, so we're not going to report rent. So it really makes it look like we had no rent expense for year 2 and year 3. And really we did. We just actually paid the cash in year 1. And here they've got net operating cash flow. And it looks like they've got the $50,000, then the cash receipts, and then they've got a $60,000 outflow, a $50,000 outflow, and a $5,000 outflow, so which gives them a net operating cash flow that's really in the hole, $65,000, because they're not considering anything such as those sales on credit or that rent is for more than 1 year. If they do the same thing under accrual base, we're going to consider the revenue as it's earned. So regardless of whether we receive cash or if it's on credit, if we've earned the revenue, we're going to report it. And then we're going to accrue that rent or divide that rent out across the years that it affects. So then you can see the difference in year 1. We actually have a net income of $20,000 because we're reporting information as we either owe it or as we earn it, and not necessarily when we pay the cash. All right, so we're going to kind of skate through this quickly, this next section. This is about the development of financial accounting and reporting standards. So I'm sure you've heard of GAAP, that's generally accepted accounting principles. And those are the principles that we use when we practice accounting in this country. So they're kind of the rules. So our accounting standard setting authorities, of course, Congress is the highest authority. They can tell us what we have to report, how we have to report it. The SEC also requires accountants to report various things in various ways. And then we've got the private sector, and now the private sector entity that we have to listen to is FASB, and that's the Financial Accounting Standards Board. Prior to that, they were the APB, and then prior to that, they were the CAP. So the Securities and Exchange Commission came about at the beginning of the Great Depression when the market crashed in 1929. And obviously, Congress was doing a lot of things at that point to try to restore investor confidence, to try to stabilize the banking system and the investing system, and try to bring some calmness to the market. So that's when the SEC came about. And then in 1933, the Security Act told companies how they had to manage initial offerings of securities, which are stocks and bonds. So it's just some regulations that were trying to protect investors. And then that was tweaked a little bit in 1934 to apply to secondary market transactions. So if you recall, secondary market transactions are not between the company and a buyer. They're between people who already own an investment that are selling to other people or other entities that want to buy that. So it's transactions outside of the company. All right, and then our standard setting. The Committee on Accounting Procedures was the first private sector body to issue standards for accounting in this country. And that was until 1959 when the Accounting Principles Board assumed that responsibility. And then in 1973, FASB was created, and that's what we have today. And they are the ones that set the U.S. accounting standards. Included in FASB is the Emerging Issues Task Force, and the Emerging Issues Task Force identifies reporting issues that may be arising due to changing markets, changing regulations, just different things that may become an issue. So they're looking out into the future as best as they can and trying to identify areas that may become a concern because of just the changes in the accounting environment, and then they try to address those in a timely manner. And then the Government Accounting Standards Board is just another board that develops accounting standards for governmental units. So they have their own set of rules that they have to follow and principles that are in place. So GASB is responsible for developing those. All right, the FASB accounting standards they are the authoritative non-governmental source of GAAP, of our accounting principles. They also include portions of SEC accounting guidance, so those also come into play. Accounting standards updates are new standards issued by FASB, and anytime you want to see what's coming down the pike or new standards that are in play, you can go to the FASB website and look at those. And this is just the way that they number those standards. So if you're looking in the books, which are quite large, for a FASB accounting standard, you can kind of find your way by looking at this numbering system. And then, as I said, FASB is the board that sets standards for the United States, but the United States is not the only country that has to report accounting information, or who has companies that report accounting information. So the International Accounting Standards Committee was formed to deal with global accounting standards, and they created a body called the International Accounting Standards Board, or the IASB. So the IASB is the international component or equivalent of FASB. And the IASB set about to develop basically the same thing that FASB does for our country. They set about to develop standards across the globe. So they began to issue international accounting standards, and they have now a system of standards that are actually fully encompass international reporting, and those are called IFRS. Those are the International Financial Reporting Standards. So IFRS is the international component or equivalent of GAAP in this country. So in this country, if you're a publicly traded company, you have to report according to GAAP. If you are a company in another country, you may be required to report according to IFRS. Some countries have adopted IFRS standards. Some countries have their own set of of GAAP that are that are that are unique to their country. So it just depends on what country you're in as to which standards you have to use. But in this country, we use GAAP. But fully aware that IFRS may be required for countries or for companies that are practicing or in business outside of the bounds of our country. And we'll just skip that. And of course, GAAP and IFRS are different because one is relevant to this country, one is relevant to, and attempted to be relevant to all countries across the globe. So it's been a long time coming, but FASB and the IASB have been trying to develop standards that are consistent internationally as well as in this country. So they worked on this for a long time. You can see the process that they went through, and we're not going to read through all those. But eventually, FASB and the IASB decided that there was just no possible way, it wasn't feasible for the United States to abandon GAAP and adopt IFRS, because there are differences in our economy, there are differences in our governmental structure and our regulations that IFRS doesn't address. And so basically what FASB and the IASB decided was that the United States would work to keep GAAP aligned with those international standards as much as possible, but that it's not feasible for them to be completely aligned. And this is just FASB's standard setting process, so we're not going to read through that. All right, so politics and standard setting. This slide is just in here because we try to be independent as accountants, and we try to report things that are unbiased and not politically driven. But sometimes politics does drive the way that we report things. And this is just an example of that. In the mid-1990s, it came to light that companies were not reporting an expense when they compensated employees when they were using stock options. So in other words, they were giving employees the option to purchase stock at a set price at some point in the future, which could be really good. If somebody guarantees you can buy a share of stock at $5 and the stock on the market is selling for $10 or $15 or $20, that's a really good deal and a potential for a good rate of return. But companies weren't reporting that as an expense. So there was some political pressure, and at some point in the 90s, there was an implementation of the Fair Value Accounting Standard, and that was in 2007, sorry about that date, which required companies to report as an expense the value of those stock options, so that they now have to report as compensation expense when they give employees stock options. And they do that by basing that expense on the fair value of the stock options when they're awarded. And this is just international politics that affect international standards. The same thing is true of that. There are politics that play a role in any time you set standards, and sometimes that's a good thing. Sometimes it may not be, so you just have to be aware of that. All right, the role of an auditor is to offer credibility to financial statements. So in this country, if you're publicly traded, you have to have a financial audit. So when you do that, an independent auditor who does not work for your company, but who is hired, or their firm is hired by your company, comes in, looks at your financial statements, and expresses an opinion about those financial statements. They hopefully will say that, yes, we believe these financial statements are in compliance with GAAP. That's their role, is to express an opinion on the company's financial statements. CPAs provide financial audits in this country. Now, there's some other kind of audits, compliance audits, operational audits, different kinds of audits that don't require a CPA, but a financial statement audit requires a CPA. And there have been increased pressures on auditors and the auditing process because there were a lot of accounting scandals, a lot of them in the late 90s, early 2000s, and you can probably see some names here that you recognize. And so Congress passed the Sarbanes-Oxley Act. You can see that abbreviated a lot of times as SOX, S-O-X. And that was a really big piece of legislation that placed a lot of structure and restrictions on auditing and financial reporting. Some of the things that Sarbanes-Oxley Act did was put in place an oversight board for publicly traded companies. They cracked down on corporate executive accountability. In other words, they really stressed that the leaders of companies, so the board of directors and management, are responsible for that financial reporting, and they have to actually attest that they are reporting things accurately, and if not, there are consequences for that. Sarbanes-Oxley restricts some non-audit services that can be done by auditing companies. So an auditing company has to be independent. They can't be doing management consulting and then going back and auditing the same company, because there's a conflict of interest there. Companies, auditors have to retain working papers, and those are just the papers that they use to document the audit process. Auditors are recommended to rotate from companies periodically, but they're not required to. But the managing partner of an audit is required to rotate, and I believe that's every 5 years. So they do have to rotate off of a company audit. So for big audit companies such as Ernst & Young, they have lots of partners, so they just have to trade partners that are overseeing the audit. And I believe, like I said, I believe that's every 5 years. Sarbanes-Oxley speaks a lot about conflicts of interest and requirements to avoid those. There's provisions and guidance on hiring auditors and about their independence, and it places greater emphasis on internal controls of a company and protecting those assets and trying to avoid and prevent fraud. And there's this conversation about moving away from rules-based standards. So we've talked about, or we can see that some of our standards seem to be principle-based, some seem to be rules-based, and the difference in those is the amount of stress on professional judgment as opposed to just a list of rules. And of course, CPAs are professionals, and part of the reason that they have to be trained and educated so much is because they are required to use professional judgment in a lot of cases. So their judgment is based, or should be based on the most fair reporting approach for a company. So, and our companies are different. So there are instances where something may work for one company and not another, and that's where the CPA comes in with professional judgment and provides guidance. That being said, that also opens the door for some abuse of power. And so there are those that would advocate just having some rules in place that have to be followed versus the professional judgment. So that's just a conversation and a difference in approach and philosophy that you just kind of need to keep in the back of your mind as you continue your accounting studies, because you know, our culture shifts from points of view, and so that may change. All right, ethics deals with the ability to distinguish right from wrong. There are all kinds of ethics codes in place for accountants. That is a huge emphasis in the accounting profession. The AICPA, the Institute of Management Accountants, and the Institute of Internal Auditors all have codes of ethics in place. You can find those on their websites. You can read them, and then there are ethics codes in place in North Carolina for licensed CPAs, and I would imagine every state has some kind of code of ethics for accountants licensed in their state. So they are making sure that you have a code to abide by in any case. All right, we're not going to walk through this, but this is just a model for ethical decision making. And you might not think about making decisions ethically by going through a 7-step process, but basically this is what you're doing, even though you might not really realize it. All right, so now some important things. to delve into. We're going to talk about the conceptual framework of accounting. You think of the conceptual framework as the accounting constitution. So it's just the framework or the foundation that lays out for the accounting standards in the United States. So as we're talking, keep that in mind. This is in this country. And here's my little chart. So we've got our conceptual framework, and you can see these elements, or each little box is piece of the conceptual framework. And we're going to talk about those because they are important. Whoops, jumped a little far ahead. So we're going to talk about qualitative characteristics and constraints. So these are just some characteristics of financial information, and these are the things we're hoping to achieve when we report financial information. So we want our information that we report to be useful. If it's not useful, then what's the point in reporting it? For it to be useful, it should be relevant. In other words, it needs to help the users predict some information in the future. It needs to confirm information that has happened already, and it needs to be material. So either it's predicting in the future, it's confirming something that's already happened. Materiality has to do with at the point of, well, does something really matter? So I like to think of materiality like this. If I lose $100 out of my wallet, I'm probably not going to be happy. That is material to me. I'm going to look around and find it because that's enough money that to lose $100 is going to affect me. If Walmart loses $100 out of a cash register somewhere, it might matter to that cashier and to that individual company, but the whole company of Walmart Corporation probably isn't going to miss $100. That $100 is not material to them in the grand scheme of things. So there comes a point in financial reporting where we don't count every penny, or we don't worry about if 5 cents is missing somewhere because it's not material. And that level of materiality, it varies depending on whether the entity is me and my wallet, or whether it's a international corporation with millions and millions of dollars. For information to be useful, it also should faithfully represent the information that it's trying to represent. So it needs to be complete. It needs to be neutral. It shouldn't be biased in any way, and it should be free from error. And I find it pretty ironic that sentence has a typo in it. So thank you, publishers. We tried to not make errors when we're doing financial reporting. Information should also be comparable, consistent, and verifiable. So we should be able to compare information from one entity to another, and we usually can because we have consistent principles called GAAP. So if all companies are reporting using the same accounting framework and the same principles, we should be able to compare information across companies, compare information from year to year in the same company. So Walmart could compare this year to last year because they are using the same set of rules to make those reports from year to year. That also goes to consistency. They're being consistent from year to year in how they report, and the information should be verifiable. In other words, if it isn't written down, it didn't happen. In accounting, we write down everything, and that way we can verify everything. And the auditors come in and verify a lot of stuff when they do audits. Information should be timely. We don't want to give financial reports that of stuff that happened 10 years ago. Our financial reports should be issued as quickly as possible after the period of time, for example, a year ends. And they should be understandable. When we say understandable by somebody with a little bit of knowledge of financial reporting. All right, we're talking about the elements of financial statements. These should all look familiar to you: assets, liabilities, equity, investments by owners, distributions to owners, our income, our revenues and expenses, and then gains and losses. Those are all elements of our financial statements. And then our recognition and measurement concepts. There are 4 basic assumptions that we work from. The economic entity assumption assumes that economic events can be identified specifically with an economic entity. In other words, when we do financial statements, we're reporting them for a particular economic entity. An example of this would be if I started an accounting firm, and so let's call it ABC Accounting. So ABC Accounting is my company, and I am an individual. So whenever I do financial statements that report on ABC Accounting, those financial statements are only going to consider financial transactions that happen for the company. I'm not going to do those financial statements and throw my house mortgage in there and my home phone bill in there and my grocery bill in there, because those things happen for me individually, and me individually is not considered part of that economic entity. So we're reporting only events that are associated for that particular entity or that particular company. The going concern assumption just assumes that a business is going to be operating indefinitely. If a company is on the verge of bankruptcy and you think that they are most likely to close in the near future, then one of the responsibilities of an accountant is to say these are the financial reports, but we really don't think this company can continue to operate. So regardless of what these financial reports may lead you to believe, this company is likely to close in the near future. Periodicity assumes that the company's financial statements are divided into artificial lumps of time. Usually we report financial statements in the period of a year. Sometimes we break those down into interim financial statements of a quarter or a month, but we break those periods of time down and we report on however we've defined that year, whether it's a calendar year or some other kind of fiscal year. And then the monetary unit assumption in the United States is just saying that we report those financial statements in dollars. All right, some other recognition, measurement, and disclosure concepts. Recognition just refers to us putting information in the financial statements. Measurement is the process of associating numeric amounts. So anything that we report, we have to measure. If we can't measure it, we can't report it. Disclosure is the process of including additional information in financial statements. So I said earlier in this video that there are 4 financial statements: the balance sheet, income statement, stockholders' equity statement, and the cash flow statement. And I also mentioned that there were some disclosure notes that go along with those. So this is what it's talking about with disclosure, putting some additional information or additional notes with that set of financial reports. And for us to recognize something, the criteria has to be that it has to be a defined component or element of the financial statements. In other words, is it an asset? Is it an expense? What is it? It has to be defined as some element. It has to be measurable. If we can't measure it, we can't recognize it. It should be relevant, and the information that we use to report it should be reliable. All right, revenue recognition. We're going to touch on this just a little bit because these rules changed not too long ago. So you all know what revenue is. It's just the inflow of assets, which could be cash or something else of value that the company gets because they provided a product or service to somebody. So they sold something and they got paid for it. That's revenue. And our revenue recognition used to be guided by the realization principle, and there was 2 criteria, and those were that the earning process had to be complete or almost complete, and there had to be reasonable certainty as to the collectability of the asset. So you had to be fairly sure you're going to get paid for what you sold, and you had to be finished providing that good or service, or almost finished. So not too long ago, FASB recently issued ASU number 2014-09, and that changed those revenue recognition principles. And so now we recognize revenue when goods or services are transferred to customers, excuse me, for the amount of the money the company expects to be entitled to receive. So there actually has to be a transference of good or service now, and then previously there didn't have to be that. So you can't say you sold something to somebody and then continue to house that in your warehouse. In the previous under the previous rules, you actually could recognize revenue even if you hadn't delivered the items. Expense recognition, there are 4 approaches. One is based on cause and effect relationship. One is associating expense with revenues, and that's called the matching principle. There can be a systematic and rational allocation for specific time periods. or that expense could be recognized in the period incurred without regard to related revenue. So GAAP allows us to take some different approaches to expense measurement. And some of the attributes that we look for are historical cost, net realizable value. So sometimes we recognize expenses based on historical cost, sometimes on net realizable value, sometimes on current cost, sometimes on present or discounted value of future cash flows, and then sometimes on fair value. In other words, what will we get if we sold those assets at this point in time? So it depends on what item you're talking about, what item is associated with the expense as to how we recognize it. So historical cost is just the cost of the original transaction. When we recognize things at historical cost, a good example of that is the purchase of land. We record land based on what we paid for it. And if we paid for it 50 years ago and paid $10 for it, then that's what we recorded it at. Historical cost for liabilities, that's just the current cash equivalent received in exchange for assuming the liability. So if we assume a liability, we would record that at historical cost, and that's the current cash equivalent that we received. Net realizable value, current cost, and present value. Net realizable value is estimating the selling price of an asset if we were to dispose of it. The current cost would be the cost that we would incur if we were to purchase or replace an asset. And then the present value is just the present value of future cash flows. So sometimes we report things at the present value of the cash that we're going to see go out in the future. So if for an annuity, for example, we'll talk about those later in this class, but if we have an annuity that we're paying out over the course of 10 years, we're going to record that at the present value of those payments. And then fair value or current market value is just based on the market value of an item at a particular time. Fair value can be measured using the market approach, so we can base the fair value on what the market rate is at that particular time. We can base the fair value on estimated future amounts that we convert to a single present value amount, and we're going to do some of those conversions to present value later on in the course. Or we can do it based on the cost approach, which is just an amount that we would have to pay if we were to replace that asset. All right, the fair value option there, and as I said, this is one of those cases where professional judgment comes in play, because GAAP says it gives a company the option to choose whether to report financial assets and liabilities at fair value. So this is one of those instances where there's not a particular rule. You have some leeway in how you're going to report. All right, disclosures. The full disclosure principle requires that financial reports include any information that is relevant and that could affect the decisions made by external users. And so you'll see that information disclosed in a variety of ways. Sometimes there are notes to the financial statements. Well, always there's notes to the financial statements, and those are just a list of explanations that are accompanying the set of financial statements. Sometimes you'll see footnotes down at the bottom of a financial statement, like almost like a little asterisk thing, or at the bottom. Usually in some small print, and then sometimes you'll see those as parenthetical comments that are actually placed on the financial statement, so just a really brief explanation that actually may appear, for example, on the balance sheet. And then sometimes there's supplemental schedules that are added to the financial statements to help describe some things. So an example of something that might be disclosed that you wouldn't be able to tell just by reading a financial report would be if you looked on the balance sheet and saw accumulated depreciation. Well, you could see that there's accumulated depreciation for an amount, But that wouldn't really tell you how that accumulated depreciation was calculated. Does the company record depreciation based on straight line or some kind of accelerated method? And that may affect how you interpret the accounting, the financial report as a whole. When you think about depreciation, or how do they value receivables, how do they report their investments. So all of those things, you could see the amounts, but you couldn't really tell the methodology for their reporting. So that's where these disclosure notes come in. So they're going to give a description of, yes, we use straight line method, and these are the assets that we have, or this is how we value our investments, or we're in the middle of a lawsuit, which may not even show up on a financial statement, but you may be required to disclose that in some circumstances. So disclosure is just is a really important part of the financial statements. All right, and of course, GAAP doesn't stay the same. As we continue to change rules, this revenue expense approach, this just emphasizes recognizing revenue and expenses along with some assets and liability to make the balance sheet reconcile with the income statement. So we want those two, the income statement and the balance sheet, to be in harmony as much as we can. So the asset liability approach recognizes and measures assets and liabilities that exist at the balance sheet dates, and then they recognize and measure revenues, expenses, gains, and losses needed to account for the change in the assets and liabilities. So the focus is on the asset and liability, and then the trickle down from that is recognizing revenues, expenses, gains, and losses over on the income statement. So for example, we know that those two financial statements link. When we record depreciation, we record accumulated depreciation and depreciation expense. Depreciation expense is on the income statement, accumulated depreciation is on the balance sheet. So thinking about an asset liability approach, we would be more worried about reporting the accumulated depreciation and those associated assets, and making sure that was the focus of our valuation, and then kind of working backwards towards the depreciation expense, and of course recognizing it in a way that's consistent with the primary focus on the asset or liability, depending on what the account is. All right, that's the end. I know that was a lot to cover, but that gets you through chapter 1. If you have any questions or something's unclear, just let me know and I will try my best to explain it.